In Module 1, we indicated that an option contract has two sides, a buyer and a seller. If you buy a call option, you would pay money to the seller of that contract. By taking the money from you, the seller of the contract agrees to sell you shares of the underlying stock at a predetermined price during a specific time. The buyer of the contract is the owner and is considered to be long that contract. On the other side, the seller of the contract is short the contract in his account. Buy 1 November IBM 140 call equals long 1 November IBM 140 call. Sell 1 November IBM 140 call equals short 1 November IBM 140 call. In the above case, the seller of the November IBM 140 call is obliged to fulfill his terms of the contract. In other words, to sell shares of IBM at $140 per share. Therefore, a seller of one contract will be obliged to sell 100 shares of IBM if the owner of the call exercises that contract. When you decide that you want to own shares of IBM at $140, you would need to inform your brokerage firm of your intent. The process is known as an exercise. After the clearinghouse has been notified by your broker, the house will randomly select another brokerage firm with clients who have sold November IBM 140 call. Ultimately, the client that receives the notice of exercise will be assigned to physically deliver the shares to you. Similarly, if you were long a put option and decided to exercise, the process will be identical to the one described above. An option's value is comprised of two elements, intrinsic and extrinsic value. The extrinsic value is also known as time value. The time value will decrease slowly with each day and tends to accelerate with about 1 week to expiration. The intrinsic value, also called the real value of an option, is the difference between stock price and strike price. So intrinsic value equals stock price minus strike price. To illustrate, consider the following example. Facebook shares were trading at $89 and an 86 call option with 30 days to expiration was selling at $6.50. Therefore, the intrinsic value is $3. That's $89 minus 86. So what would be the time value for the contract? The answer would be the difference of the premium and intrinsic value, or $6.50 minus $3, which equals $3.50. Depending whether you bought or sold a contract, the time value could work to your disadvantage or advantage. Remember, at expiration, the option would be stripped from its time value. The only value that option would have is the intrinsic. Understanding both how intrinsic and extrinsic value works could make the difference between making and losing money when trading options. The term describes the option strike price in relationship to the stock price. A call is considered in the money, or ITM, when its strike price is less than the stock price. At the money, or ATM, when the strike price is the same as the stock price. Out of the money, or OTM, when the strike price is above the stock price. A put is considered in the money when the strike price is greater than the stock price. At the money, when the strike price is equal to the stock price. And out of the money, when the strike price is less than the stock price. You may note that options with intrinsic value are considered ITM, while options with no intrinsic value are OTM. So let's review what you've learned. A buyer of an option is considered to be long that contract. On the other hand, a seller of an option is considered to be short. If the buyer exercises the option to purchase a stock, he would have to notify his brokerage firm. The broker will notify a clearinghouse and randomly assign the notice to another brokerage firm. The premium of an option consists of extrinsic and intrinsic value. As an option buyer, you would lose the extrinsic value at expiration. Moneyness refers to how close a strike price is to the stock price. In the money, options have embedded intrinsic value, while at the money may have little intrinsic value. Out of the money options have none. Understanding how options value works could be the difference between making and losing money.